Hello, everyone. I'm Joanne Lilly, the Director of Content Programming at CEDA. Welcome to CEDA's live stream today, Australia's mid-year economic assessment, where we're joined by leading experts to discuss the report card for the Australian economy as we approach the midpoint of the calendar year and the end of the financial year. Before we start, CEDA acknowledges that today and every day we are on Aboriginal land. In my case today here in Melbourne, that's the land of the Wurundjeri people of the Kulin Nation. I offer my respects to elders past, present and emerging. At CEDA, we support the stated aspirations of our Indigenous communities and we're committed to reconciliation and recognition. Before we start today, just a little bit of housekeeping. CEDA's program in the second half of 2021 will continue to offer a diverse array of discussion forums, both face-to-face and virtual, to allow people from all corners of the country to debate critical issues of Australia's economic and social development. To keep abreast of our range of events and discussions, we encourage you to visit CEDA's website, that's ceda.com.au, where you can register for upcoming events and recordings of past live streams, and also access our range of podcasts, video interviews and blogs with leading experts and policymakers to make sure that you stay up to date with quality information on key issues impacting Australia's economic and social development. Today, as at all CEDA events, you'll be able to interact with our speakers through our Q&A portal, which is available via the link on your video screen. Or you can enter the details by going to ceda.pigeonhole.at and using the passcode MYEA, as in Mid-Year Economic Assessment, so MYEA, all one word, all caps. Post your own questions and you can also vote on questions that have been posted by others. You can also join the conversation or invite others to join on Twitter by using today's hashtag, which is hashtag MYEA, and tagging CEDA at CEDA_news. Now, turning our attention to today's discussion. After farewelling the incredibly challenging year that was 2020, there's been a growing sense of relief in much of Australia as our economy has appeared to bounce back from a challenging year in a way that perhaps exceeded expectations. Now, at the midpoint in the calendar cycle and the end of the financial year, what do economists really make of Australia's economic performance? Are we as strongly placed as we think? And what are the challenges and opportunities that lie ahead? Today, you'll hear from a panel of leading economists as they unpack these issues from multiple perspectives, both domestic and international. It's my great pleasure now to welcome and introduce Stephen Halmarick, the Chief Economist and Head of Global Economic Market Research at Commonwealth Bank. Stephen is our keynote speaker today and will present a 15-minute assessment of the Australian economy. We'll follow this with a panel discussion facilitated by Nadine Blayney, who's the Head of Content at Ausbiz, where she also leads the editorial team while anchoring the daily markets coverage. Stephen, welcome and over to you.
Thank you very much, Joe, for that kind introduction, and it's certainly fantastic to be with everybody here today. So, as mentioned, I'm going to run through a very brief outlook for the Australian economy, and I'm going to particularly focus on the internally generated data that we can generate at the Commonwealth Bank that gives us great insights into what's happening in the Australian economy very quickly, and then I'll run through a brief summary of what we think that might mean for the Reserve Bank. So I'm just going to start with one slide on the global economy, and I'm sure we'll talk about a lot more about this in the panel discussion. So we're expecting global economic growth this year of about 6.3%, so quite a very strong recovery after the recession of last year. But the global recovery is not even. You can see from the chart here that China is certainly leading the economic recovery. Of course, it went into the recession earliest, out first, and has resumed a very strong trajectory of growth. And that, of course, is being driven by industrial production and infrastructure spending, which has been incredibly supportive to Australia, most obvious in the iron ore price back around $220 a tonne today. The US economic recovery is continuing. Certainly the vaccine rollout there is accelerated since the election, and fiscal policy being a big support. But we're still, there is some areas of concern in the world, particularly countries like India. Some of the scenes out of there, obviously quite distressing. But one of the other things that's happened over the course of the last year or so even while we've been in the COVID-19 recession, is the renewed focus on climate change policy, particularly coming out of the US. And I think that's been a really positive development. So hopes are high, I think, for some really positive and meaningful change on that front. Now let's focus on Australia. So we can see here the Australian GDP and the unemployment rate, our forecasts, very much looks like a V-shaped recovery to us. Of course, the first quarter GDP numbers that were out a week or so ago reinforce that view, 1.8% growth for the quarter, and the economy now larger than it was pre-COVID. To our mind, there's these 7 factors that are driving economic growth. So we've done a great job in controlling the virus. Certainly there's been some renewed issues in Victoria in recent days, although I think I saw on the news this morning that there was no cases in Victoria over the last 24 hours. The rollout of the vaccine has probably been slower than many of us would have liked to have seen, but I think that's now accelerating, and that's the silver lining on the situation in Victoria, is that more people now will go get vaccinated. Consumer confidence is very high. There's been a surge in household savings, and I'll show you some charts on that. The housing market's incredibly strong. Again, I can show you some charts on that, not just prices and construction, but lending activity. A big jump in domestic tourism as we've all holidayed at home rather than offshore. Strong iron ore exports, and particularly a big increase in public sector infrastructure spending. And I would imagine we're going to hear a lot more about that as the state government budgets roll out over the next few weeks. So we do see the unemployment rate continuing to fall. We have it down at 5% at the end of this year and 4.7% at the end of next year. Of course, we had the budget deficit a few weeks back, and I think the main summary there is the budget deficits are going to remain quite large for a number of years, larger than we had originally expected. In fact, the deficits in financial year 23 and 24 are actually going to be larger than the MyEFO estimates. And the bottom line there is that the extra revenue and the extra spending, so the extra revenue and the reduction in spending that was available to the government in the budget, a large chunk of that has been spent in the years to come. So you can see from the chart on the right here that spending as a share of GDP holds up at levels much higher than pre-COVID for a number of years. So that mindset change from the government on fiscal policy is really quite significant, and I think quite welcome. And that's going to help drive economic activity for a number of years. Now, I think the area of the economy where the turnaround has been most remarkable is the labour market. Of course, we'll get some more data on this on Thursday. You can see on the left here, the unemployment rate, now 5.5%, still a bit above where it was pre-COVID, but as I said earlier, we think heading lower. Importantly, the underemployment rate is now lower than it was pre-COVID. You can see that there's been over 900,000 jobs created since June last year and April this year. We expect another 30,000 increase in the employment number this week. So that's ongoing good news. Really strong recovery in the participation rate and hours worked as well. So strength in the labour market, really welcome to see. Now, I mentioned right at the front that one of the things that is a real advantage in the Commonwealth Bank is our access to internally generated data. So all this data is anonymised and aggregated, so you certainly can't see any individuals, but we can see the aggregate as a whole, given the very large size of the Commonwealth Bank in the Australian economy. So some examples of this data here, we go from the left, that's job seeker. So the blue line is the number of people with a bank account receiving job seeker payments, the unemployment benefit, and the red is the value of those payments. Of course, the job seeker value was almost doubled from $550 a fortnight to $1,100 a fortnight for a while. So when COVID-19 hit, there was a bit over a doubling of the number of bank accounts receiving job seeker, and the value increased quite dramatically. You can see from this chart, really from about September, October last year, we had this steady decline in the number of people receiving job seeker, and then really from early this year, it declined quite quickly. So there's actually now less people on job seeker, less people with a Commonwealth Bank account on job seeker than there was pre-COVID. And the fact that we could see the job seeker numbers declining from around about September, October last year really gave us a lot of confidence that the economy was recovering quite quickly. So we were able to call a recovery in the Australian economy from around about October, November last year, some 6 months earlier than the Commonwealth Treasury and the Reserve Bank, and their forecasts are now very similar to ours. The second chart shows wages, salaries and government benefits coming into CBA bank accounts. So the green bars is wages and salaries being paid into bank accounts. That includes JobKeeper. And you can see when COVID hit, that chart went to negative territory, volatile for quite some time, but now is accelerating. So even after the end of JobKeeper, there's an acceleration underway in the value of wages and salaries being paid into CBA bank accounts. You can see the yellow line is government benefits paid in, so job seeker, pension payments, other welfare recipients. So just a wall of money coming into bank accounts through the COVID-19 recession. So what I like to say, is the weirdest recession ever, because there was more income coming into CBA bank accounts through the recession than there was before. And of course, this was government money, job seeker, JobKeeper payments. So there's a significant amount of income flowing into people's bank accounts. We can see from the CBA cash savings indicator that a large amount of that money was saved. In fact, the national accounts show that there was over $140 billion of extra savings through 2020 and the first quarter of 21. And you can see the household savings ratio jumped sharply higher. It's come back a bit in the last quarter, but still well above where it was pre-COVID. So Australians are sitting on a large pool of savings, around 7% of GDP, that can be deployed as the year goes on. In terms of spending, there's a number of ways that we can look at spending. One of them is what we call the Household Spending Intentions Series. And this data is released monthly on the third Tuesday of the month, which just happens to be today. So the May data was released just this morning. Now, in this Household Spending Intention series, what we do is we combine actual transaction data through the CBA network with Google search terms. And we use Google search terms as an indicator of what do people intend to spend money on. We've worked with Google extensively to develop this product. Google tell us we're the only bank in the world doing this. So it's a fantastic insight into not only spending currently, but people's spending intentions. Now we compare, we compare each month with the same month the previous year. So when we look at May 2021 versus May last year, lots of volatility because May last year was really the second month of the significant lockdowns. But if we compare May this year to May 2019, home buying, retail, health and fitness, entertainment and car buying spending are all higher than they were in 2019. The travel spending is still lower than it was, and that relates mostly to the closure of the international borders. So the annual charts look like this. You can see the home buying numbers incredibly strong, lots of volatility in retail. Travel is picking up, but most of that is domestic. Health and fitness spending, very strong. Entertainment pulled back last month compared to May last year, but still picking up, as is education and motor vehicle spending. So some very good signs for spending now and also intentions to spend. Another way we can look at spending is through weekly credit and debit card spending. So this is a very valuable source of information. CBA credit and debit cards account for about 30% of all cards on issue. Excuse me. And about 30% of all the terminals out there. And we can get this data weekly. So every Monday, I receive information on what was spent up until midnight the previous Friday. So rather than waiting for the monthly ABS retail sales data, that takes about 5 weeks, we get weekly data every Monday. So the revolution in data is quite phenomenal. Now, so up until last Friday, you can see total spending was weakening a little bit, just below 15%. So the last couple of weeks spending has slowed, and I'll show you in a moment. All the weakness in spending in the last 2 weeks is in Victoria due to the lockdowns there. So in this chart, the black line compares 2020 to 2019, the yellow this year to 2019. You can see good spending has slowed in the last couple of weeks, but it's still increasing by about 18% compared to the same week in 2019. Services spending, again, a little bit slower in the last week. It's up about 10% compared to the same week in 2019. So as I mentioned, we can slice this by state, and you can see all the state breakdowns here. Clearly, the weakness is in Victoria. What we can see, though, is when states do have lockdowns, there's a significant and very fast reduction in spending. When the lockdowns end, spending goes pretty much straight back up to where it was pre-lockdown. So as the lockdown in Melbourne ends, we would expect to see Victorian spending back up to that level, a bit above 15% per annum. The scale's a little bit different here, but what these charts do show us is that spending is strongest outside of Victoria and New South Wales. So Queensland, WA, South Australia and Tassie all growing at a faster pace than Victoria and New South Wales. And that reflects in part the fact that services spending has been softer in the big states, New South Wales and Victoria. We can also cut this data by spending activity. So you can see food spending is pretty much back to normal. Tons of volatility in alcohol spending, but again, pretty much back to normal. Household furnishings and equipment was really very strong throughout 2020 as people rushed to the shops to fix their houses and buy furniture and tables or paint or lots of other renovation activities. Clothing and footwear had been normalising, but a bit weaker in the last week or so. Recreation, similarly, transport pretty flat. So this is a fantastic source of very quick data on consumer activity. Elsewhere in the economy, we can see home lending rocketing higher. The chart on the top right-hand corner here is home loan approvals, a quite phenomenal increase in owner-occupier lending, but investors picking up now as well, as has first home buyers. And you can see from the bottom left, that's across just about every state. The chart on the bottom right is really significant. So pre-COVID, around 14% of all home loan applications received at Commonwealth Bank were for a fixed rate mortgage. That's now about 45%. So the very low fixed rate mortgages have been incredibly popular. For a while there, you could get a 4-year fixed rate mortgage at 1.99%. And again, as I said, very popular both for owner occupiers and investors. So those recovery in the the recovery in the labour market and very low fixed rate mortgages get you this boom in home lending that's resulted in the increase in prices. To date, the business capex sector has been the missing link in the recovery, but the most recent ABS survey on capex expectations does show some positive momentum, and we're looking for a 15% increase in business capex over financial year 2022. You can see business lending from the Commonwealth Bank been pretty volatile, but overall a little bit stronger in the first few months of this year compared to last year. I did mention earlier there's an infrastructure boom underway. You don't have to move very far around Sydney or Melbourne or even some of the other capital cities to see all the big infrastructure spending. And as I mentioned earlier, I think there'll be more of that in the state budget. So that's a really strong support for the economy going forward. So our forecasts are that both wages growth and inflation will be higher than the Reserve Bank's expectations. We expect wages growth to be 2.7% at the end of next year. We expect to see inflation back into the target range by the end of next year. One of the important things on wages growth is the fact that the border remains closed, the international border. We think that lack of supply of global labour coming into Australia effectively raises the NARU, and we'll see more wages growth than the RBA currently expects. So we had the minutes from the last RBA board meeting just this morning. Not a lot new in there, but I think as people will be aware, the July board meeting is the critical one. We still think the RBA is going to signal that an increase in the cash rate is 2024 at the earliest, but the economic data is challenging that view, and we think the risk is for a cash rate rise earlier than 2024. The term funding facility will end at the end of this month. There's been about $200 billion drawn down from that. We think the pace of quantitative easing will decline, The RBA may announce a tapering down to $50 billion rather than $100 billion of the first two programs, or maybe a more flexible program. Either way, we think they'll begin to taper that QE program. And we think the yield curve control will stay with the April 2024 bond and not move to the November 2024, allowing them more fixed flexibility on the cash rate as that bond rolls down the yield curve. And then there's my disclaimer. So I'll leave it at there. Thanks very much.
Well, hello, everyone. Nadine from Ausbiz here. Thanks, Stephen, for that opening keynote address. Very firm foundations on which we will start our panel discussion. So for this panel discussion, we have local and international economic experts, and we'll be discussing both the domestic economic performance and outlook, but also how Australia sits in the global context. And from that, we'll touch upon potentially G7 and also, those ongoing US-China tensions from a policy perspective, but we won't get too bogged down in everything. I'm really curious to delve a little bit deeper into some of those local economic indicators. Just a bit of housekeeping before we continue. Today, as at all CEDA events, really, you're able to interact with the speakers through a live Q&A. So we have a Q&A portal, which is available via the link below the video. So just below the video on your screen, you can find that link. Or if you're having troubles with that, you can enter the details by going to ceda.pigeonhole.at and using the passcode MYEA. So we'll attempt to answer this Q&A where appropriate throughout this panel discussion, and we'll endeavor to leave a little bit of time at the end as well. Please, as always, join the conversation via Twitter. Use today's hashtag, which is hashtag MYEA, and you can tag CEDA at CEDA_news. Now, let me introduce our panel members today. Again, we've got Stephen Halmarick, Chief Economist, Head of Global Economic Market Research at Commonwealth Bank, who you've met already. Cherelle Murphy, who's Chief Economist at Austrade. And we're also welcoming Justin Wolfers, so Professor of Public Policy and Economics at the University of Michigan. Welcome all. All right, Justin, I might start with you just to get a bit of a perspective on the global growth context, US growth in particular. I know you're in Australia right now, but your ties are obviously deep in the US. Is the recovery in the US being felt on Main Street? Or are there other pressures that are starting to come in, whether that be the withdrawal of some stimulus, a fourth stimulus check looking unlikely, and we keep hearing about price pressures building?
Yeah, I think this is a remarkably easy recovery in some respects. That's because it was a remarkably unusual recession, which is you shut an economy down. At first, through lockdowns and the law, and then through much of 2020 and all the way through the first half of 2021, there's still a voluntary withdrawal from the market. People are worried about the virus. They've got good reason to be worried about the virus. And one very simple way of conceptualizing that is to think of it as being a tax on all service sector interactions. And it's a very high tax. So it's kept people away from the service sector. That was the downturn. That makes the upturn remarkably simple, which is if you remove that tax and you remove those lockdowns, then people are going to return to market. And that's exactly what we're seeing. So much as Australia talked about a V-shaped recovery, and you've got Morrison here boasting of one, you've got Biden boasting of one over there. But in some sense, there's not a lot to boast about. This is just the simple arithmetic of when you shut a store down and then you open it back up, in the data, that looks like a V. So yes, this is being felt on Main Street. Employment's returning. There are important questions about how far it's going to return. So if you focused in the US only on the unemployment rate, it looks like the unemployment rate is back down to something not too unreasonable. But if you look at the number of jobs, it turns out that, we originally lost 20 million jobs and we got 12 million of them back, which means we're about 8 million jobs short right now. And that's really the big question going forward of how much, whether that's a temporary thing that people are trying to stay out of the market while they're still worried about the disease, or whether they're going to return to the market. You mentioned stimulus. There's been huge stimulus in the United States. It's not just the Fed, of course, which has kept interest rates at zero and been absolutely determined to keep them low and communicated quite well on that. The Biden stimulus is bigger than many predicted, and it's coming at a time when the unemployment rate is sort of 5 point something, which is not typically when you'd be throwing trillions of dollars at the economy. So as long as, there's only one economic indicator that matters for figuring out the future of the global economy, and it's what happens to the disease. And as long as the variants stay at bay and the industrialized countries are moving towards vaccination rates that really will keep the disease at bay, then you're going to see a return to economic health as well.
And on that point, we've got the 4th of July approaching swiftly in the US. We'll be hearing from the President Joe Biden about, plenty about his likely legacy in terms of green credentials, et cetera, but also about this vaccine rollout itself and the tremendous logistical hurdles that the US has really climbed. But to the point about inflation and economic policy and stimulus, are you of the view that massive infrastructure spending to the extent Joe Biden is proposing is still necessary?
Well, there's two questions there. There's a microeconomic question and a macroeconomic question. The microeconomic question is, does the US economy have sufficient infrastructure to sustain a modern, vibrant economy? And I think the judgment of most economists on that is no, it doesn't. There's been tremendous decay and insufficient investment for literally decades, whether it's transportation infrastructure, communication infrastructure, or even my partner who's worked with the administration is Betsy Stevenson's made the point we could think about things like childcare as a form of infrastructure. You need childcare in order to be able to get back to work. So the microeconomics of it are, yes, the US has a great need for infrastructure. The macroeconomics are, do you want to spend trillions of dollars all in 1 year right away, right now, while there's so much going on in the economy? And that's where I think there's not much debate about the total price tag of the spending bills, but there are harder questions whether we should have it as much front-loaded into 2021 and 22, or whether we'd be better off allocating it out over the next 5 years, for instance.
It's an interesting question because, of course, infrastructure by its very nature does often take a long time to roll out. We'll leave that thought there. Cherelle, to Justin's point, when things shut down, they snap back. And that's what we've seen through this weird recession, in Stephen's words. But the elephant in the room locally, Cherelle, is that our borders remain closed and there's no clear plan as to when and how they're going to open. Last week, we had New South Wales launching a pilot program in terms of international students. Is that what we need, in your view, to keep this V-shaped recovery on track?
Thanks, Nadine. Look, there's no doubt at all that the closure of the international borders has actually both supply and demand side impacts. As we're hearing before from Stephen, the fact that we can't get as many international workers in is certainly impacting the labour supply. And then the demand side, clearly we're losing, billions of dollars from international tourists and students in particular, as you mentioned, who can't get in. So, we certainly, as New South Wales have done, are planning that slow reintroduction of students back into the country. That is likely to continue. We've seen a travel bubble open up with New Zealand. There's some talk of it continuing to other countries like Singapore. So I think it's really a step-by-step progress. But, as the government and Minister Tien has said many times, it's obviously not the only concern, and health concerns are predominant in this analysis as well.
Yeah, health always, is forefront, and it will continue to be so. But Stephen, we've got this massive stimulus spending right around the world, both monetary and fiscal. We heard from this G7 Plus summit on the weekend talk of leveling up, which is very much a Biden term, talking about coming through this recovery and trying to enhance the level of equality, or at least decrease inequality in the economy. And then we get, house price figures out today in Australia. Housing is just going gangbuster. Does this then put housing affordability higher up on the agenda?
Well, Australia is not alone in seeing house prices rise dramatically. I was in New Zealand last week, and it's the same issue there, and I think the same issue in Canada as well. So it's happening because the labour market's recovered, and as I mentioned earlier, because interest rates are very low, so Australians are borrowing lots of money on the housing market.
And I just add, I was just going to add, Stephen, might be also related to the fact that $65 billion not being spent overseas, which is not replacing domestic holidays too.
Yeah, very, very, very true. So people have more disposable income that they might put into their home. I think the issue for me is sometimes the policy response to that is to make it easier for people to buy a home by giving them more money. So, first home buyer schemes, deductions on stamp duty, etc. So it just increases demand. So if you increase demand and you don't increase the supply, then there's only one result. We all learn in Economics 101, right? Which is the price goes up. So I think it's really going to be important to focus on the supply side. And whilst the population growth rate's down, I think this is the opportunity to really accelerate the construction of new residential properties in Australia. Because when international borders do reopen, we're going to have more demand coming from there as well.
I just wanted to underline what Stephen said. I think, one very simple way of thinking about the Australian housing market is we have basically a vertical supply curve that a range of restrictions make it almost impossible to build more. If that's the case, then anything you do on the demand side is only going to have an effect on prices, and it's not going to put more people in homes. That suggests that what we really need to do is every time we have a conversation about housing, we talk about supply, because it's the supply side that seems to be really very constrained.
Yeah. You got two economists agreeing on something there, so there we go.
Fantastic. We'll keep that going. Perhaps then I'll just try to address one of the questions that's come in from the audience from Dom, saying thoughts on the potential for wage growth in the short to medium term. I think you touched upon that, Stephen, but it is interesting that we get the RBA minutes today. They are saying that annual wage growth would need to be sustainably above 3% to reach that inflation target. Currently, I think that wages growth is at 1.5%. I mean, how do you incorporate the RBA's firm view on wages into your outlook?
Well, there's a couple of things there. So one is, how quickly will wages growth recover? And as I mentioned in our presentation, we think wages growth will recover earlier than the RBA does. But in a sense, things like wages growth, that's kind of the last thing to move. And the question then is, will we get inflation without wages growth being above 3%? So lots of the feedback I get from companies, talking to lots of companies around Australia, is that there's lots of other things that are happening that might force them to raise prices. So not just tight labour markets and wages growth, but they're certainly highlighting that. And everywhere I go, no matter what industry I speak to, people are complaining or pointing out to me that there's a shortage of skilled labour. Trying to get enough people for the jobs available is difficult, which seems kind of crazy with the unemployment rate still at 5.5%. But there's other costs that are rising. Logistics, supply chain, insurance costs are increasing, and commodity prices are increasing. So there could be other sources of inflation other than just wages growth. So as I mentioned in the presentation, we think both wages growth and inflation will be a bit higher, a bit earlier than the Reserve Bank's forecast.
Cherelle, what are you hearing there at Austrade from exporters? You are very much at the coalface.
Well, interestingly, if we look at the tourism sector, which is absolutely at the coalface of this is a sector that we're hearing a lot from in terms of difficulty in finding staff. And of course, that is the sector of the economy which is arguably the weakest. So when you have the weakest sector of your economy saying it's difficult to find staff, it does suggest to me that the pressures in the labour market are a bit different than they have been, and certainly different to what they were just prior to this crisis. And I'd add, it's not just skilled staff, it's unskilled staff too. So we're seeing it from, I guess, two pressure points in there. Across the export sector, it's probably a little bit difficult to generalise. Clearly some parts of the export sector are doing exceptionally well at the moment. iron ore being a case in point, whereas others are struggling with what COVID has handed them, and also the trade conditions with China. So, things do differ a little bit from the demand side. From the supply side, probably not so much. And again, I think it's more those service-oriented businesses where, often we see working holiday makers and temporary migrants fill their spots. That's where the difficulties are.
Justin?
I want to add two things. The first is, while Stephen's right that there are inflationary pressures beyond wages, things like logistics, they're one-off things. The cost of getting a container ship here is much higher than it ever was. There's no way that's going to become an ongoing source of inflation. So there's going to be a lot of blips in the data, and it's going to be up to each of us to look through it. In terms of the points that Cherelle was making, they're very much, again, about Australia having its borders closed to people. And that then suggests that the really important thing for our economic policy going forward is, how is it that we can get the borders reopened? And that ultimately is going to come back to vaccination policy. So you can start by talking about wages or any economic issue, and it all ultimately comes back to, where are we with the disease? And of course, that's going to be where are we at with vaccinations?
Yeah, certainly so. That sort of brings me to a next question coming from our audience. This is from Craig. It says, will the large stimulus measures distort the relationship between GDP and underlying activity levels for individual industries? And what is the outlook for inflation with globally synchronized growth? And I think we'll start with the inflation piece of that, because that's sort of where we are right now. So, Justin, can I take from your answer that you're very much in the Fed's transitory inflation camp?
I'm in it's really hard to know camp. Look, here's the simplest model of the Australian economy is different than much of the rest of the world because we just haven't been hit as badly. But here's a simple model for what's going on in the rest of the world. It's basically one big game of 52 card pickup. Every business had to close, had to open, workers are here, firms are here, they're reopening, they're not sure they can find each other. And it's just going to take a while for that whole thing to grind its way out and work its way through the system. And so does one margin look distorted? They all look distorted. This is the most extraordinary, difficult to read economy of any of our lifetimes. So any economist who looks you in the eye and says, I am certain that the following will happen, or even confident, is having you on. We should be open to just about any possibility. For sure, I think that we are seeing a little bit of an inflationary pressure, but the harder question is how much of that is going to be persistent. And that really comes back to how much is this reflecting this creaky reopening versus deeper economic forces. And obviously at the moment, the creaky reopening is the dominant force in the global economy.
Stephen, do you believe that the massive amount of stimulus that has been pumped into this economy from all angles has distorted the relationship between GDP and the underlying actual activity levels for industries?
Well, I think it's certainly a new development for Australia. The fact that we've got a government, a conservative government that is now pushing a very easy fiscal policy agenda. Well, it's welcome. I think a lot of people have been calling for that for a long time, including us at the Commonwealth Bank. So having the support of fiscal policy for the economy is really good news. Standard & Poor's have upgraded our, the outlook of our AAA credit rating from negative to stable, with debt going from 30% to 40% of GDP. So that tells you that the economic return of the debt is going to far exceed the interest cost. So in that sense, you do that trade every day. So that means the economy should actually be stronger than it was pre-COVID, because you're going to have fiscal policy a lot easier, a lot more supportive. Now, different parts of the economy will respond in different ways to that, because the government money is in different sections of the economy. Now, who needs support? But I think the highlight of the budget was just how broad the economic support from the fiscal policy is. There's virtually no part of the economy that didn't get extra money in the budget. Whether that persists for a couple of years, not too sure. But, the GDP is all of the economy added up together. It's not going to be exactly the same as it was pre-COVID, but most sectors are looking, most sectors, not all, most are looking better than they were pre-COVID, because there's more fiscal support as well as the monetary support.
This is a question from Tony. What trade actions / consequences do you see coming from China potentially in response to the more unified and assertive, you could say, approach that's being taken by the G7 economies, including Australia? Justin, I'll start with you on this one.
I think China's relationship to Australia is really quite different than its relationship everywhere else. The simple version of this, and Cherelle, I'm sure, will have views, is China's decided, it's going to play the bully with Australia and have a go, and it can't do that with other countries. And so the tenor of the conversations in Australia about China are utterly different than what you see in the United States and much of Europe. Relationships have been approximately strained forever. But it's in the Chinese best interest to have useful economic relations with the US and vice versa. And I think that's just the way that relationship's going to continue. That even President Trump couldn't disrupt that relationship probably tells you something about how robust it is.
Stephen?
Well, I think the interesting thing is Australia's total exports to China are rising, but it's all iron ore. So,
in fact, if you take out iron ore, Australia's exports to China are down 40%. So it just shows you how distorted that is.
Yeah, that's exactly right. So I think, Cherelle, I'm right in saying that iron ore is worth more than every other export combined, doubled.
Yeah.
It's iron ore at $220 a tonne. So then the question I often get is, China impose tariffs / sanctions on Australian iron ore. Well, that'd be probably the biggest, economic own goal you'd ever seen, right? Because there's nowhere else on the planet that China can get iron ore in the quality and quantity that they require. So it's a really interesting situation where you've got all these other exporters in Australia, wine and beef and barley and lobsters, and the list goes on, significantly affected by the actions on China, yet our trade surplus to China remains very large because of iron ore. So not too sure what the end game is here. But I think more, G7 want a more rules-based global trading system. That'd be a good idea.
Yeah, they're basically calling for a revitalized WTO. Cherelle, bottom line, is it fair to say to continue growth in Australia without the specter and threat of Chinese tariffs, that at the very basic, we need to diversify our exports. We need to diversify the markets that we export into.
Look, Nadine, yes, but it's already happening. When you look, for example, at coal exports, as we know, coal exports to China are virtually zero at the moment, but there's been a massive increase in exports to other countries. And so India, Japan, South Korea, Taiwan are at the forefront of that. You see similar things in other markets like barley. Again, China has obviously put significant sanctions on that for Australian barley, but Australian barley is now going to Mexico. It's now one of the ingredients in Heineken. It's been exported in massive quantities to Saudi Arabia. No, it's not obviously necessarily a clean swap in some cases. We look at other markets like lobster and, yes, we are selling lots of lobster to the rest of the world, whereas we used to sell mostly to China, but it's at a lower price. And so the export value and the export income that comes from that is obviously lower. So my watch talking to me.
Sorry, I'm still not sure about that.
My watch doesn't know the answer. So we're seeing diversification in lots of markets. And look, Austrade's been really kind of active in this as well, of course. The government put $70 billion into an agribusiness expansion fund, which is essentially about giving us money to help exporters, particularly in the agribusiness sector, to find those alternate markets. And that is working. We can measure concentration of markets through a number of ways. There's an HHI index, which gives us a nice little indicator. It grosses things up and it shows you how concentrated a market is. And what we've seen is that since about the middle of last year, that concentration has come down when you look across our exports. So it is already happening.
Okay, might be surprising, I guess, because we focus on iron ore so much. But, how about value adding? We heard from Tesla's chair, Robin Denham, a couple of weeks ago, just talking about the fact that we're digging all these minerals out of the ground and exporting them off, where they are then processed and used. What is the sort of push? What is your view on having more of that value add done here in Australia before exporting?
Yeah, look, it is interesting in the sense that, you're right, that most of what we export, and again, it just comes down to iron ore and our other major mineral exports, but mainly iron ore, that we have been, essentially pushing that primary product overseas without a lot of manufacture in the process. The truth is it's obviously been working for us. It's our comparative advantage. It does seem likely that those high prices won't continue forever. And there is definitely, the prospect that we can be, our export income is simply not going to maintain those kind of levels because prices come off. Now, does that open up the question of should we be doing more here? Should we be sort of more integrated into supply chains? I think it's hard to argue that no, that's a bad idea. I think we do need to sort of be pushing into that area. And certainly we have a lot of sophisticated manufacturing exports. We are the world leaders in some aspects of technology and fintech. We're great at regtech. And these are all small stories at the moment, but the potential for them to grow is huge. And especially given this well-educated population, which really is, when it comes down to it, one of our greatest assets. So I think, there's definitely a case for that. And again, I think it's already happening. It's just on a smaller scale and it gets crowded out by the minerals and resources story.
Mm-hmm. Climate change was on the agenda at the G7 and the G7 finance ministers meeting. So talking about climate change, biodiversity, and really bringing about sort of structural reform to put a price on carbon. Justin, when we talk about the economic recovery, do we also need to look at it through that climate prism? How important is that to be part of the conversation around economic growth going forward?
I think you're hitting on something quite a bit more general, and it's actually a critique of our conversation so far, which is we as economists have a tendency to focus on the economic things we measure, gross domestic product being one of them. But of course, living a good life is more than that. And so it includes things like being able to breathe clean air. And so sometimes people say, well, this come at a cost. And if by cost you mean would we trade off some gross domestic product for some unmeasured benefits that are greater? Yes. But the fact that they're unmeasured doesn't make them benefits any less. And I think more broadly, we economists need to be careful to broaden the lens to make sure that we're including the full set of benefits. So yes, we want to be thinking about the environmental benefits of particular reforms like a carbon tax. Yes, we want to think about a bunch of other unmeasured benefits as we're able to reopen the economy. Like, a third of us are from immigrant families. We'll be able to visit them again. That's a benefit. It's measured in love and smiles rather than dollars, but we economists should be unashamed about saying we stand up for all benefits everywhere, including love and including the environment.
Well, Stephen, I don't know how you feel about measuring love and smiles, but if we take a look at household wealth here in Australia, as we emerge from this recovery, this V-shaped recovery, there's been a lot of money being put in people's bank accounts, as you pointed out. Are those people likely to go out and spend it? Are those the people likely to go out and spend it and to keep the consumer part of this economy bubbling right along?
Well, first thing to say is I'm a massive fan of Love and Smile, so very keen on both those for my family. So I should also say that, and maybe this is similar to what Justin was saying, we do a stream of work in the research team at CBA that we call Beyond Economics. So we write a lot of research on things that are beyond just GDP and inflation and the latest unemployment rate. The circular economy, carbon markets, biodiversity. We actually write research and publish research on all those things and many more. And we think it's a really critical part of what we do as a research team for the bank. and very supported by the bank in that and our clients. So we're really pushing hard into that space. In terms of the cash that's sitting in people's bank accounts, will it get spent? Well, the evidence is it is being spent. The household savings ratio is still higher than it was pre-COVID, but it's coming down. And it's the people's money. They can spend it whenever they like. So we do think that that'll be one of the key supports for the economy as we go through the year. There'll be ups and downs. Maybe there's recent lockdowns in Victoria, etc. So things will ebb and flow as the vaccine rollout happens. But there's a lot of money sitting in people's bank accounts, and we think they will spend it over the next year or two.
And Stephen, we do have that jobs report on Thursday.
Yeah.
We're still cycling through JobKeeper. So as money continues to come into bank accounts, mortgages continue to be paid. However, is it possible we could see a weak print come Thursday because it's sort of the tail end of JobKeeper coming off?
So when we look at the wages and salaries being paid in the CBA bank accounts, we look at job seeker being paid in the CBA bank accounts. It's hard to see any impact at all on the labour market from the end of JobKeeper. And the ABS actually said that when they released their April report, a month ago. So we're expecting 20,000 for jobs for this month. So that's a bit softer than, in fact, the average for the last 6 months or so. So there may be an impact at the end of JobKeeper, but it'd be very short term. It may all be behind us, but we can't see any significant impact from the end of JobKeeper in the data that flows through the CBA network, which, if that's true, that's a fantastic outcome. Okay,
so just to finish off here, because we still do have a few questions coming in from the audience. Conscious of time as well, I'll just start with this one. Coming from somebody who asks, are the initiatives to revitalise the CBD of our cities working? I suppose you'd need to have a take on whether or not everybody's going to be keen to come back to the office and get things going again. Justin, what's your sense?
I think that we need to realise that the future economy may be different than the past economy, and a lot of this is going to be about people making different and better choices. Again, some of this is not going to be measured in GDP, but if your employer is able to find a way for you to work from home and that helps you better balance work and family, that's a massive benefit for you, whether it shows up in the economic data. The reason I raise that is we hear things from the premiers trying to encourage businesses back into the CBDs in order to reopen the local coffee shops. Problem is, what you're doing there is you're just relocating economic activity from my suburban coffee shop to the CBD coffee shop. And the truth is, if I prefer to be in the suburbs, that's actually an economic loss. And so I think we really do need to give space for what's going to be a massive realignment of urban design, the cities that people want to be in, whether they want to be in the suburbs or actually up and down the coast, and provide the infrastructure for what is a once-in-a-lifetime chance to reinvent the shape of our cities.
Can I just add there, Nadine, that it's interesting to see in the tourism space how much the regions have come back faster than the cities. And, that's obviously not related to workplace issues, but it is related perhaps to the want of people to be in more regional areas, to be less crowded, etc. But, there's a lot to be said for working at home and holidaying in the city, when your home is out in the region. So, maybe we'll actually see a little bit of a reversal of that. You come to the city for your theatres and your great restaurants, etc. when you're on holiday. So who knows? It's a kind of a change perhaps in the way that we view our geographic boundaries.
Now, while I have you, Cherelle, we've had a question come in, and I think it's a nice way to end the discussion. Michael says, what grade would each of our speakers award to Australia at this point, presumably on how we've managed this pandemic? Now, Justin, I know you said that Australia nailed 2020, still has a bit of work to do in 2021. So out of 1 to 5, how do you think policymakers have either helped or hindered Australia's recovery?
Yeah, so I'm a professor, so we use A's, B's and C's. So 2020 Australia was an A+, maybe even A++, the best in the world. 2021, the failure to vaccinate people, where other countries have managed it, means the borders stay closed through 2021 and through 2022. There's some politics in all of this. No one wants to take risks before an election, but it's an abysmal vaccination rollout and as bad as any industrialized country. So it's a C- from me.
Cherelle, you can stick with the letters or you can go back to numbers 1 to 5, I guess 5 being the best. But how do you rate how we have handled this recession, this weird recession, and the recovery from here?
Well, look, I mean, I think the combination of the flexibility that we've seen from the government, the flexibility we've seen from the Reserve Bank, its willingness to really kind of get stuck in there and really put in place stimulus that we hadn't seen before, despite, of course, not knowing what the future, I guess, of the or the near future of the economy looked like. The flexibility even that we've seen in rental markets, for example, that we've seen landlords execute on, has all been fantastic. So I'm going to give it an A+. And of course, that's got nothing to do with the fact that I am a good public servant.
Of course. And Stephen, final word to you. I know that you endorse the level of spending, that this government has undertaken, the change in mindset, I think you called it, on behalf of the federal government in terms of fiscal policy. So give us a rating.
Yeah, I think in 2020, it was very strong, A+, was governments at all levels, the Reserve Bank, and I should say the banking system, really responded incredibly well to the challenge. Maybe it's pulled back a little bit this year, as Justin said, but I still think it's a pretty solid A.
All right. And that is where we will end this panel discussion. Thank you. Huge thank you to Stephen Halmarick, Cherelle Murphy, and Justin Wolfers, of course, for joining us, being open with their comments, and also responding to a lot of the questions that came in. Apology to those of you out in the audience. We didn't get to all of your questions. However, we're always up against the clock when it comes to these types of events. So thank you for your time in joining us. And of course, your participation in the discussion to all of our panel, our expert guests. If you have missed some of it or would like to go back and rewatch, don't forget that this discussion has been recorded and it will be available on the CEDA website shortly. Feel free as well to share with your colleagues and your network, anybody who you think might benefit from listening into this conversation. As always, you can keep up with what's happening at CEDA's program by visiting ceda.com.au and register for the following upcoming events via the website. So there's a State of the Nation, which is on the 23rd to 25th of June, Empowering First Nations People with a focus on employment on the 30th of June, 2021. So again, Stephen, thanks for setting the scene. For a solid foundation. Cherelle, there's so much going on in terms of the export world. We focus so much in on iron ore. It's fascinating to know that there's lots going on under the hood, and particularly in some of those innovative areas such as agribusiness and agri-tech, I suppose, which we didn't get to delve too far into. And Justin, great to have you back on Australian shores, bringing the global perspective and reminding us that economics can also be about love and smiles and how we measure that and address that at times as well. Now, you please continue the conversation. You connect with CEDA via LinkedIn, via Twitter, Instagram, YouTube, Facebook, all of those normal social media channels. And for now, I hope you enjoy the rest of your day.